Welcome, everyone. I'm Susan Murray. I'm one of the partners at Truss Associates, and on behalf of my colleagues and the team at Edison, I'm delighted to welcome you here today to our webinar. As many of you will know, we ran 3 webinars earlier on in the year, and we focused on COVID-related challenges relating to the investment industry. We thought it'd be appropriate to round off what has been a very extraordinary year in all senses, with the review of some of the industry trends that have emerged and a focus on the opportunities that we see for investment companies in 2021. We're delighted to welcome back 2 of our earlier panel speakers, Joe Winkley and Andrew Summers, and we've also got a new speaker with us today, Elisabeth Scott. Welcome all 3. So just some very brief introductions to our panel. Joe Winkley, I'm sure, is very well known to many of you. He's head of investment trusts at Winterfloods and has over 15 years experience in investment funds, advising over 50 investment companies. Joe's responsible for all the listed fund transactions at Winterfloods, and that includes the IPOs, issuance, and corporate advisory work. Elisabeth Scott. Elisabeth is a very experienced non-exec director and chair. She began her career as a trainee investment manager at British Investment Trust before moving on to roles at Edinburgh Fund Managers and Schroders. She then set up or took up non-exec roles at Allianz Technology, Dunedin Income and Growth, Fidelity China Special Situations, and is chair at India Capital Growth Fund. Elisabeth is also the deputy chair at the AIC. And last but clearly not least, Andrew Summers. Andrew is head of fund research at Investec Wealth and Investment, and he's responsible for the team covering collectives research. And today he's going to focus on the investor perspective. So just before we start, just a couple of housekeeping points. Each of our 3 speakers is going to speak for around 5 to 10 minutes. Now that's going to leave plenty of time, we hope, for questions at the end. And we're going to aim for a finish time of around 11:45 a.m. If you would like to ask questions, and please feel free to do so, if you could use the Q&A tabs at the bottom of the screen, and we'll do our very best to cover just as many as we possibly can. Now, our speakers today are going to cover the subject matter from the perspective of the advisor, the board, and the investor. So without any further ado, I'm going to pass across to Joe in the first instance.
Good morning, everyone. So the topic today is beyond the pandemic, looking forwards. But I thought I would act as a little bit of a scene setter here and look backwards and just look over the last year. So the first slide I've got here, this shows you the sector discount over the last 12 months. And as you can see, and I think you'll all remember quite well, the moments back in March where the discount widened out across the sector to over 25%. And obviously that's an average. And so you'd seen individual trusts where the discount would have been far wider than that. I think the message here is really, if you look at where we start and where we finish, actually, we are not far off in terms of the average discount where we were this time last year. But obviously, it's been a very, very rocky journey, and I'm not sure that journey is completely finished yet. But it is worth just kind of looking at this year in context. If we can have the next slide, you can see how the 25-year historic sector discount, you can see how the discount this year as a sector, it is analogous with the financial crisis back in 07-08. But it was far shorter. You can see, I mean, it's hard to tell looking at the scale here, but it took a long time for the discounts to come back in 07-08. But you can see here that we've rebounded very quickly within the space of 12 months. And in fact, a lot of the rebounding took place in a shorter period. And again, if you look at it in a historic sense, actually overall, we are still very close to historic highs for discounts, or rather historic lows for discounts. So actually the sector is not in a bad place. And you can see in terms of performance, at the beginning of the year, the overall trust sector pretty much correlated with the FTSE All-Share. But you can see actually as the FTSE has gradually recovered, actually the investment trust sector has outperformed and has recovered faster and quicker, which I think is very good for the industry as a whole. Getting into the next slide, which I'm sorry for those of you with small screens, a little bit detailed. This is really just looking at performance by subsectors, because obviously the performance you've seen so far is very much looking at the sector as a whole. But if you break it down, where does that performance come from? On the left-hand side, you've got NAV performance. On the right-hand side, you have share price performance, and they're fairly similar in terms of the names you see there. And obviously at the top, we've seen very strong performance for technology, global, Asia Pacific. I'll come on to talk about that in a little bit because that's quite an interesting one. And then obviously North America, Japan. And when you look at the laggards, it's kind of what you'd expect. It's the UK, UK small cap. And if you look at share price performance, because obviously the NAVs are a little bit delayed, you've got UK commercial property. So I think the message here is that obviously ex-UK and particularly tech have been very strong, and UK as a whole has been weak from a performance perspective. But when you kind of look at what does that mean in terms of, we've seen the discounts, we've seen the performance, what does that mean in terms of where ratings are? Again, nothing has really changed actually over the last year in terms of the highest rated sectors. Premiums are hard to find. And obviously, if you look at the two on the far right, renewable energy and infrastructure, they have been very strong over the period. They re-rated very quickly. And sorry, just coming on to this slide, next slide, this one, yeah, re-rating. So what we're looking at here is the movement in discounts or premiums sector by sector. And what I think is quite interesting here is that we have seen a bit of a change over the course of 2020, where there are a number of sectors which I would say at the beginning of the year were struggling more from a discount perspective, which has seen, partly as a result of strong performance, partly as a result of sentiment, has seen some re-rating. And I think Asia Pacific is a really interesting sector in that regard. We've seen particularly China funds, some very aggressive re-rating there. But even across the wider emerging markets, we've also seen re-ratings. And obviously commodities and natural resources, very volatile. But over the course of the year, from where we started, actually, we have seen a re-rating over the course of the year. Moving on to what's happened in terms of fundraising. The last 12 months, and let's kind of go up to September, the last 12 months prior to October, it's fair to say fundraising market was very difficult. Particularly the IPO market, and obviously the results of the outcome from March, April, May, June. It's kind of what you might expect when you've got significant market volatility. You've got a lot of investor uncertainty. I think we are now coming out of the other side of that, and I don't want to sound overly optimistic, but when you look at what happened in October, where we not only saw significant fundraising, and that's the largest month for fundraising for a couple of years. But also we saw the IPO market open up again. We've seen Roundhill come out with a music royalties fund, we've seen Home REIT, and we've seen some other IPOs get away. And I think that is really positive for the sector, because when you have got just secondary market issuance, it means that certain sectors and certain funds, and again, the focus has been very much on renewables and infrastructure, have managed to grow. But you always want to see new funds coming through. So it's not easy, and we have seen some failures along the way, particularly on kind of specialist UK focused funds. But I think if you look at that overall picture, it's fairly optimistic. And this page really gives you a bit of context in terms of what I was saying about the IPO market. So what we're looking at here is, on the left-hand side, it's issuance by type, and you can see the vast majority of issuance is being secondary issuance, only circa 10% IPO. And to put that in context, on the right-hand side, you've got the amount of IPO money raised versus the amount of total issuance raised. And you can see that looking back, 2020 is likely to end up as one of the worst relative years for IPOs versus secondary market issuance. Albeit that actually, I think by the end of the year, we might get to a point where overall levels of issuance have actually been not far off the historic norms. So that's kind of a very, very whistle-stop kind of tour through what happened in 2020. I think now it's about looking forward. So what do I see as the key themes for next year? The one at the top of the list is ESG, and I've included impact investing. But I think what we are beginning to see in the investment trust space is a real change in the way that people are looking, and I'm thinking of both investors, but also boards and managers are looking at ESG. And if you roll back a few years, I think you're all aware that ESG was something that was referenced, but it was largely paid lip service. I think we are now seeing ESG becoming far more important in terms of the way that managers invest. It's becoming embedded in investment process. And I think the next evolution of this is going to be quantification. Everyone has their own idea of what ESG is and what it means. But when you look at the way that certain funds are reporting it, I'm thinking of something like F&C, which has been reporting, F&C Investment Trust, its carbon intensity. A recent announcement by Edison that they are going to have a third-party ESG audit and include negative screening in their investments. And obviously the change from Keystone Investment Trust very recently to the Baillie Gifford positive change investing. I think this is a theme we're going to see far more of going forwards. Dividends clearly a big theme of 2020 across the board. Clearly the real estate sector has been very badly impacted from a dividend perspective, but so has the equity income sector. A number of trusts have bought, have used revenue reserves in order to increase, maintain their dividends. But nonetheless, we've seen some fallers in the AIC dividend heroes. I think we've had 3 fallers so far. And the recent announcement by Invesco Income Growth means there'll be 4 fallers from the dividend heroes. And the big question for you as boards and directors is what to do going forwards and how long can you use reserves to support dividends and what are we going to see into 2021? That will be really interesting. Discount premium, I think this is not just about discount, it is about premiums. And we've seen, as we'd expect, a lot of volatility in both. In terms of discounts, we've seen a lot of movements around and there is still volatility in terms of discounts. I think as boards, the real question is at what point do you intervene? But I've put premiums here because actually we've seen extreme premiums as well. And the recent Baillie Gifford China Fund, I think, got up to at one point a 34% premium. And I think it is worth bearing in mind that extreme volatility between discount premium, having a large premium is almost as bad in many respects as having a large discount. And then finally, I will touch on sources of demand. And this is something I think Andrew will pick up on. Many of you might have seen the Times article today, which is talking about the investment trust sector. And I think the phrase was that when wealth managers were shunning investment trusts of less than 400 million in size, and in some cases more than $1 billion in size, there has been a lot of consolidation in the wealth management sector. And I think it's really important for boards to think about where the sources of demand will come from. I think on a positive note, and I'll finish on this note, there has been significant retail demand all the way through the pandemic. Retail has been very sticky investors and have been strong followers of investment trusts. But obviously that raises questions in terms of how you access that, how you engage with retail investors. It is difficult, but I think looking forward, I think one of the questions as a board is who are your buyers? How do you maintain them and how do you attract them? So, that's me, I think, very quickly, and I will stop at that point.
Thank you very much, Joe. Just before we move on to Elisabeth, can I just double check on behalf of one of our audience, were VCTs included in your figures?
VCTs would not be included in those figures, no.
Okay, thank you. Great. Over to you, Elisabeth.
Thank you very much, Susan, and good morning, everybody. And thank you to both Trust Associates and to Edison for inviting me to speak today. And what a year 2020 has been. Amazingly, I think the AIC statistics, which would include VCTs, show that investment company assets have grown over the year as a whole. And I think about at the end of 2019, assets for investment companies were about £200 billion, and at the end of October, they were about £208 billion. So there has been an increase in the assets. But for most investment company directors, it doesn't necessarily feel like that's been the case. And I'm sure if you'd asked any of us in March how we thought the year would turn out, we wouldn't have been expecting a positive return. I thought today I'd talk about my experience as chair of India Capital Growth this year, as a case study of some of the issues that boards have been dealing with. To set the scene, and I think this chart of our share price, the net asset value, and the discount, which is the pale blue line, tells you quite a lot about the challenges that I and my fellow directors on India Capital Growth, but many other directors of investment companies have faced during the year. India Capital Growth is a small investment trust. Today, its market cap is about £94 million, and it invests in Indian mid and small cap stocks. It had a period of strong performance between 2014 and 2017, but the performance had deteriorated with poor numbers both in 2018 and 2019. And in part, those were due to style. This is a growth fund with the growth manager, but also some poor stock selection. And as a board in 2019, certainly we've been working with the manager, putting pressure on the manager to add resources to a relatively small team. And they'd responded very positively to that. They'd added a new co-head of Indian equities and 3 new analysts. They'd reviewed their investment process, and they'd added more discipline to their buy and sell processes, and they were using AI to draw in more information to their value screens. So as we set out into 2020, the board felt that the investment management structure had improved, and we expected that we would see an improvement in performance start to come through. However, we were facing a continuation vote related to performance in August 2020. And as a board, we felt it was unlikely that even if performance improved, it would improve sufficiently to avoid triggering the vote. So I think, Charlie, we could move to the timeline chart now. So I think just from the timeline chart, you can see that things were relatively quiet up until April 2020, and then it all kicked off. So on the 11th of March 2020, we had a board meeting in Guernsey, and we took the decision to look at our options for bringing forward the continuation vote, and to find a way to ensure that our shareholders could benefit from the returns that we believed could be generated by the fund. And it's important, I think, to emphasise here that the board had a reasonable degree of confidence that the measures were in place to see performance improve, and that it was worthwhile looking at ways for the trust to continue. And so we began a period of intense hard work. Firstly, we needed to formulate a plan that would benefit shareholders and meet with their approval. And secondly, we needed to issue a prospectus and complete all the other legal requirements. And all of this, of course, was taking place in the midst of a pandemic. Because the week of our board meeting in Guernsey was Cheltenham Week, when the coronavirus began to spread much more widely across the UK. And most of us as non-executive directors will only have to deal with this sort of corporate activity a few times in our careers. I'd only had one previous experience of a continuation vote as a board member, and that was for Pacific Horizon in the early 2010s. So my first tip for any of you facing a similar challenge is make sure that you're surrounded by competent, qualified advisors who you trust. How often have we all sat in board meetings, sorry Joe, and wondered what the brokers do to earn their fees? But at this point of a continuation vote, this is when they really come into their own. And as we worked through April, May and early June, with the corporate financier in his cottage in Perthshire, the lawyer in Devon, the manager in Hampshire, the directors in Guernsey and in Oxfordshire, the plan came together, the prospectus was written and rewritten and rewritten and rewritten. And we put forward a proposal to introduce a biennial redemption facility starting in December 2021. And alongside that, we changed the fee structure from 1.25% of NAV to 1.25% of market cap. And then we had to work on a plan to engage with our shareholders. A communication strategy was put together. We used the sales team at the brokers, the sales team at the manager to engage with our largest shareholders on the register. But we also worked with a firm of proxy consultants to engage with shareholders further down the list. And we decided that we'd use technology to the greatest extent possible so that shareholders could understand the proposals that the board was making and the rationale for them. With the help of our PR agency, the manager hosted webinars, which allowed questions and answers. A research report was published, and even I was persuaded to appear in a video on the website. The vote took place at an EGM on the 12th of June. The continuation was passed and the redemption facility approved. The turnout was over 60% of shareholders, and all proposals were passed by more than 90%, which did mean that at least that more than 50% of our shareholders had voted in favour of the proposals. So since then, what have we done, and how are we going to carry this momentum forward into 2021? In the autumn, we conducted a Section 793 exercise, and I know that this has been mentioned in previous webinars. And we could write to 895 of our retail shareholders who invest via platforms, and we invited them to attend a webinar with a short presentation from me and an update from the fund manager. Over 110 investors signed up and almost 100 attended. So that was a really good turnout, we felt. The fund manager hosted a virtual trip to India with the portfolio managers interviewing some investment company managements. And instead of a Diwali dinner, we hosted a tasting of Indian gin and whiskey for journalists. On the timeline, you can see the communications plan for 2021. Webinars, thought pieces, paid for research notes, all disseminated as widely as possible. It helps, I think, that people are interested in India and that the marketplace isn't too crowded. So there are opportunities for press coverage and thought leadership as well. Clearly, as a board, we want to see the performance improvement bed in. With better performance, we expect the discount to narrow. We want shareholders to have the information they need in order to make the right decisions for themselves as they decide whether or not to redeem. So we feel it is important to continue efforts to engage with shareholders to the greatest extent possible. The board has committed publicly that if we believe the size of the company is too small after the redemption vote, we will bring forward proposals to enable shareholders to realise their investment in full. And of course, it's still too early to say how things will go in 2021, but it certainly looks as if it's going to be another busy year. Many thanks.
Thank you very much, Elisabeth. Great. So we're just going to move on to our final speaker, Andrew. And can I please just encourage the audience, if you do have any questions, do feel free, please, to add them through the Q&A tab at the bottom of the screen. Andrew, over to you.
Thank you very much. Excuse me. Thank you very much, Susan, and good morning, everybody. Before I begin, I should set the scene by stating that our engagement as an investment company investor is increasing exponentially. And partly this is due to regulation, which, as you know, now encourages and indeed obliges shareholders such as ourselves to actively engage with our investment companies. But it is also a reflection of industry changes that have given more clout to us as shareholders. Firstly, industry consolidation has been rapid and will continue, resulting, all other things being equal, in fewer but larger wealth management shareholders. Secondly, through commercial and regulatory pressures, investment decision-making is becoming more centralized, meaning that when we do speak, there is more force behind our words. And finally, third-party corporate governance service providers are starting to offer to undertake engagement on behalf of wealth managers. And in this scenario, multiple underlying shareholders' engagement efforts are consolidated and acted upon by one party. So together, this means that representatives of wealth managers with whom boards engage, whether in-house or external, are likely to speak for a larger shareholding, and any subsequent actions will be more impactful. So bearing that in mind, let me now turn my attention to a couple of corporate governance examples that we have experienced in the course of 2020. We've seen several examples this year of specialist niche investment companies getting into trouble that may well have been avoided had boards had more appropriate experience and engagement to truly oversee the manager. And reflecting upon this, we feel that many boards understandably see their role as avoiding getting into the weeds and setting high-level strategy. And we would say certainly stay out of the weeds when it comes to day-to-day decision-making. But boards, please do absolutely roll your sleeves up when it comes to oversight and challenge. And this should not be left to the, quote, technical guy, unquote, on the board that sometimes we hear. When we look at a board and their other roles, are we confident that the board in its entirety would have the hours, days, or weeks possibly required if the proverbial hit the fan? Does each member of the board have the time, if a big problem occurred in their particular area of competence, to meaningfully address the issues? And we've been very active in 2020 in ensuring sufficient and focused technical skill on boards. Another area is when an investment company fundamentally changes its proposition, for example, through a change of manager or a material change in an investment objective, we expect shareholders to be offered a cash exit at NAV less costs. Because in our opinion, it is not acceptable for boards to fundamentally change the nature of an investment offering without a shareholder vote and without offering this facility. If boards are confident of their decision, what have they got to lose? And following on from this example, we expect boards to be imaginative and not performance chasers. How many mandates have we seen move from value to growth in 2020? And in some instances, literally right at the bottom of the market. Now, there may be many reasons to question the future prospects of some value strategies, but this should be based on a clear, forward-looking belief rather than a hope that a move to a more in vogue investment style will lead to a re-rating. Another huge topic continues to be costs. Ad valorem fees allow investment managers to increase their revenue over the medium term due to market movements. And if you assume a 7% a year growth rate for equities over the long term, an investment manager doubles their revenue every 10 years for doing no extra work. And the operational gearing on that is phenomenal. So if you assume the benefits of this market growth were to be shared equally between the investment manager and the shareholder, a 100 basis points AMC today would equate to 75 basis points AMC in 10 years' time. In other words, in equities at least, long-term market movements upwards, if shared equally between the manager and the shareholder, would lead to about a 2 to 3 basis point reduction in AMC every year. And our estimates suggest that many investment managers are making egregious profit margins on many of their investment company mandates. And we are really concerned that this could be the executive pay scandal of the future. And so we are encouraging boards to look beyond narrow peer group comparisons towards other metrics to determine the appropriateness of fee levels, including, quite simply put, what sort of profit margin do you think these investment managers are making on a mandate? More broadly, we encourage boards to continue to consider opportunities to return capital to shareholders. Performance-related tenders do a great job of increasing the alignment between investment manager and shareholder. And as I've said before, fixed capital has many advantages, but fixed capital also has a disadvantage. Investment managers need to know they have a realistic prospect of losing AUM and revenue should their performance be subpar. And in our experience, boards sometimes feel that they can't really do anything to reduce the size of the company, especially if they're starting from a quite small position. And this is definitely a consideration, but often the benefits of things like tenders, especially performance-related tenders, will outweigh the cost and the size considerations. And a quick sidebar on this, if I may, we've seen a trend in 2020 towards longer notice periods in investment management agreements in return for lower fees or capital that is less fixed. And we don't think this is an appropriate quid pro quo. If longer notice periods are indeed in the best interest of shareholders, and frankly, they rarely are, but if they are, then the additional revenue a longer notice period guarantees the fund manager. That additional revenue should be returned to shareholders at the time of the notice period extension. Otherwise, all that happens is with an extended notice period, you are ensuring a net transfer of shareholder wealth from the shareholder to the fund manager. And we don't think that is typically justifiable. In general, we encourage companies to be imaginative. Fortune favors the brave. In the last year, we've supported equity issuance below NAV because it was nevertheless value accretive. We've been happy to agree aggressive share buybacks by small and illiquid companies because the discount was such that this was clearly a better use of capital than investing in underlying assets. We've welcomed income-focused strategies, cutting their dividend in the short term to fund investments that will boost income in the long term. We've supported M&A. We are and we want to be long-term investors. And things are changing. And if we want boards to be open-minded, then we as shareholders have to be open-minded as well. So bringing this all together, this leads me to one conclusion. Shareholders are stepping up to their obligations, better late than never. We have responsibilities too, after all, and that manifests itself, I believe, in the need for more engagement with boards. And that doesn't mean bringing us inside a day or two before an RNS is announced. That isn't really engagement, that's pre-notification. It means both parties, shareholders and boards, working together. And we started off talking about how shareholders are becoming more vocal. And we are now talking to more and more of our fellow shareholders. And we've been surprised by how many of them are willing to speak out more vocally and act on their views. Many of you will have seen that we have for the first time proactively sought a continuation vote this year with a view to winding up the company, and it won't be the last. We were pleasantly surprised to see how putting our head above the parapet has encouraged other shareholders to do so. So just to wrap up, as those of you who have spoken with me before know, we absolutely believe that boards are vital to the investment company centre. You collectively perform a crucial function. Boards are really one of the key competitive advantages of the closed-ended sector, and a strong board can and does make all the difference in the world to long-term shareholder returns. And as a large and vocal investor, and we suspect increasingly so in both respects, we offer our hand to boards to work together constructively for the long-term benefits of our clients, your shareholders. Thank you, Susan.
Thank you very much, Andrew. That's great. Now, I've got quite a few questions coming through, so let's go straight onto them, and I'll try and give everyone a sort of reasonable spread. There's a general question here from Alan Giles. With continuing consolidation among wealth managers, do you think this will heighten liquidity concerns and therefore marginalise smaller trusts and lead to consolidation across the sector? Let's give everyone a crack at this one because it's quite topical for all sorts of reasons. Elizabeth, do you want to have a go at that one first?
Yes, yes, okay. I think it definitely does heighten liquidity concerns, absolutely. And it probably means that some of the smaller investment companies are not going to appear, wealth managers are not going to appear in the shareholder registers of some of the smaller investment companies. It also means, as non-executives, that we have to look elsewhere to our shareholders, whether it's the retail shareholders on platforms, and I talked about the Section 793, so you can start to drill down into who those are, and also to some of the regional wealth management companies as well. So, I don't think that it spells the end of the small investment company or small specialist investment company, but it certainly means that you have to be very conscious of the opportunities elsewhere. And I absolutely, heard what Andrew was saying about the importance of the role of the board to the wealth management firms, and certainly, the boards that I sit on, we try our hardest to engage with the wealth management firms and take every opportunity to do that.
Thank you, Elizabeth. Joe, would you like to come in on that one?
Yeah, I mean, I think what Andrew was saying was really interesting, because I've got to say my knee-jerk reaction, particularly reading things like the Times article this morning about consolidation, is that we've been talking about consolidation in the sector, funds being too small for years and years and years, and there's never really been that catalyst for things to change. And I think I'm not pointing the finger at the shareholders, because I think it comes from a number of different sources. But what we haven't had is boards really, particularly smaller trusts, being put under pressure to merge or to consolidate. What you typically find is that they often kind of stumble along, carry on going, and even though market commentators may say, well, wouldn't it make sense if X, Y, and Z put themselves together, it very rarely happens. And it's fair to say we are seeing a little bit more in terms of M&A activity in the sector, which I think is all to the good. But if you said to me, do I think we are seeing or going to see a sea change? No, I don't. And I think it's also worth noting that in some cases, we don't necessarily need to see consolidation or change, because coming back to what I was saying about kind of the investor ownership and shareholders, I think it's perfectly fair to say that there are some trusts which probably have the wrong shareholder register to be sub 100 million in size. But there are other trusts, and we act as broker to some, where they are sub 100 million in size, but the ownership is almost exclusively retail platforms, and there is liquidity for the kind of trading that needs to happen. And actually, in some cases, you see quite a lot of liquidity, because if you are owned by the Hargreaves, AJ Bell, Interactive, you've got quite a lot of daily trade going on. And is that too small? Well, no, because I think those investors, it's the right size. Would it be too small for Andrew, an investor? Then quite possibly. So again, I think it's not a kind of one size fits all. But coming back to the starting question, do I think we're going to see a lot of consolidation? Probably not, is my feeling.
Okay, thanks, Joe. Andrew, could I give one to you, please? Question here. You make comments obviously about the board's skill set and time capacity, particularly really when things do go wrong. Would you like to see a limit on the number of boards per director? What are your views on that?
I think it's very hard to set firm rules, because you just don't really know how much time or effort a particular role might take. But I think that, and I think we can all agree, I'm sure directors would agree, that when things are going well, you could probably have quite a large portfolio of directorships. But it's when there's a real problem, you've got to drop everything else and suddenly focus on one thing. So I think that if you're seeing more than say 3 or 4 substantial board roles, I think that one would ask oneself, okay, if either of those companies had a problem, or 2 of those companies had a problem at the same time, and the chances are that individual, if they've accumulated that number of board roles, they're probably highly active in lots of other areas as well, and that's fantastic. But one could start to see how they might be a little stretched at points. So I think it's a case-by-case basis, but there are so many fantastic people out there in the potential role of NEDs today, and we're looking for more diversity. I would just encourage boards to perhaps look further afield than, you know, somebody that's already got 2 or 3 positions. What, just expand your imagination and your horizons if you can.
Thank you, Andrew. Elizabeth's piece, clearly, her case study clearly sort of had a lot of resonance with people, and there's quite a few questions. So I'll try and pick out the sort of key things for you, Elisabeth. So we had a question, what would you have done differently with the benefit of hindsight? Somebody asked a very relevant question. You said 74 million was rather small. How do you decide how small that is, or what too small is? And a very good question saying, did the experience on that particular board and with that particular set of circumstances change your focus or activities in your other roles?
I'll start off with the what would I have done differently? Well, not too much, actually. It was pretty tough at the time, and we were all. I was certainly learning as I went along, but I think the outcome was positive. So I think you just have to roll up your sleeves and get on with it, really. And it was, of course, really, really interesting. It's it's very, very interesting to be involved in a corporate activity like that, and reaching out to shareholders, talking to people. You really learn a lot, and I hope that if it comes up again, I'd be able to use those skills. Perhaps I'd be a bit more efficiently, and I'd probably know sooner what questions to ask. On the question of size, we said very publicly that if after the redemption facility takes place in December 2021, we felt that the fund size was too small, and at that point we gave an example of £40 million, we would put forward proposals to shareholders. And I still think that's I don't know what the right size will be at the time, but I think that much below 50 million, and one would be feeling probably a bit uncomfortable. And the last question, sorry, Susan, you have to remind me again. Oh, about focus, sorry, about my focus on the other trusts. Well, we were meeting at least weekly. So it didn't affect my other work at the time. That all continued. We were meeting weekly on the project, sometimes more often, but it could be fitted around other things that I had ongoing. So luckily, I wasn't facing any other crises at the time.
Excellent, thank you, Elisabeth. Can I throw one open to all of you? Various comments obviously been made about shareholder alignment and engagement. How will the role of AGMs of the future evolve? Joe, do you want to perhaps take that one?
Role of AGMs of the future. It's hard to tell. I mean, I think one of the things I think really needs to be focused on is shareholder voting, and I think that we are seeing, and Andrew alluded to this, we are seeing far more proactivity from wealth managers. I think there are pros and cons of having proxy voting advisors, and there'll be a number of board members here who'll be shaking their heads thinking about various directions that have come out of the likes of PERC and ISS. But I think overall having more people voting is really important. I guess where my concern comes is the growth of the retail investment trust, which I think over the last few years has been a real positive, and we're continuing to see it going forwards. But it's about how do you get those to vote? And coming back to what I was saying before, if you have a small trust, which is almost entirely retail held, you can have a 3, 4, 5% shareholder who can really control what happens with that trust. And I think that's going to be one of the big challenges in terms of investment trusts going forward. It's, I think getting the engagement with the wealth managers is great, but I think it's going that next level down, getting engagement with retail investors, and how do you get them to vote? And I think there's still a lot of work that needs to be done there.
Great, thank you. Andrew, do you want to come in on that one?
Not really, sorry, Susan. I mean, we tend to engage outside of the AGM process. I think Joe's absolutely right. It's you know, AGMs are all about the retail investor and how you can aggregate their thinking and engage them.
Okay, we have a question coming through. Why do speakers prefer redemptions to a continuing buyback facility? Does anyone want to take that one?
Well, I'm happy to take it because I'm not sure that I do necessarily. I think it really does depend, would be my feeling. I think in some cases, things like, as Andrew alluded to, things like conditional tenders, tender offers, they are appropriate when you are dealing with a particular circumstance or a particular event. If it is just a kind of ongoing, you know, sector is slightly out of vogue, you are seeing a bit of selling, I think share buybacks are perfectly appropriate. So I think I would take a step back and say, what is the problem that you're trying to address, and what is the most appropriate way of addressing it? I don't think there is a one-size-fits-all answer to that one.
Okay, we've talked a lot about small trusts and the difficulties of that. Here's a question. Can the panel talk more about the advantages of size in investment trusts? Do you think investment trusts over $1 billion will receive increased focus in the future, and small funds less, obviously? Does anyone want to pick up on the other side of the size equation? Andrew?
I can talk about it. I mean, yes. I mean, size is really just, I hate to flog a dead horse here, but it's really, really crucial. And Joe's absolutely right that it doesn't really impact the retail investor necessarily, but it really does impact the wealth management clients. And we're doing a project at the moment where we might be looking to centralize our investment decision making a little bit more as a firm. And when I was just thinking about just running some scenario analysis in terms of seeing how could we, you know, what would that mean in terms of the size of the tickets and the sorts of flows that my team might be responsible for directing going forward, I was starting to get worried a little bit about the infrastructure space. You know, and they are £2-3 billion. So for some of us, it really is quite important. And again, it isn't just necessarily the size of our AUM that's the problem. It's the fact that 5 years ago, 20, 30, 40, 50, 100, 200, 400 investment managers would all be making their own decisions, putting in lots of little tickets. And increasingly, those investment managers are now relying on me more, whether they want to do that or whether they're being forced to do that. It's being relied on more by me. And all those little different decisions are being consolidated into a small group of people in my team. So I'm increasingly concerned and increasingly think that the bigger almost the better, so long as you're not going to impact performance. And that's a separate conversation because sometimes you do.
Thank you, Andrew. Elisabeth, do you want to come in on that one?
Well, as you know, I also sit on the boards of a couple of larger investment companies, and certainly the conversations we have there about liquidity are very different from those that you're having when you're talking about a £100 million investment company, you know, and I think that particularly at Fidelity China, as an example, you know, we feel very strongly that the liquidity is there in the shares, and when which still happens from time to time. Wealth managers say, oh, well, we're not really sure we can buy enough stock. We're quite surprised by those comments because we believe that there is sufficient liquidity out there for wealth managers to get what they need and get the exposure to China through buying that company. And the same would apply to Allianz Technology Trust as well. There is liquidity there if you want it.
Elisabeth, I guess I'll just put it in the context of saying we run £30 billion. This is purely academic, but if we ran £30 billion and we're increasingly moving to a more model-based sort of investment proposition, and we said we really like Fidelity China, let's put 1% of our model into that. That's £300 million. And all of a sudden that then creates sort of other issues, you know, and, you know, we might want to put 2% and then it becomes £600 million. So you start to get into really big numbers. That's the challenge.
Yes, I agree, and I you know, the good thing is there's more than one China investment company, but yes, I can see that. But in the same way, I think that, you know, your option, of course, is either going with the emerging market route or going with the open-ended funds, and you know, that's where your investment decision making is really important. Certainly, as far as I'm aware, we're not running out of capacity to manage. Fidelity China isn't running out of capacity to manage in the style that it currently does so. So we'd welcome everybody's investment.
Perfect. Thank you. In the interest of time, I'm going to ask each of our speakers just to really round up with a key message. So we'll do it in order. Joe, can I pass across to you first of all?
So key message for next year, I think it is going to be an interesting year. To my mind, I think the areas that I'm going to be really looking at is ESG. I think that's going to be a huge growth area for the whole sector, and I think the way people look at that is really going to change. I think it's already changing. And dividends. I think dividends is going to be the other big focus. There'll be a lot of board discussions around dividends, continuing them, cutting them, increasing them, paying out of capital, all of this kind of stuff. So those are my two themes for next year.
Thanks, Joe. Elisabeth.
Well, I'll go with Joe actually on ESG. I think that as boards, we are all considering how to make sure that we provide appropriate transparency in what we're writing about the trusts, whether it's in the annual report or in half-yearly statements or other public things. Every manager, in my experience, every manager's approaching this differently. So there's very little consistency. I think what we can also say is that some of the sort of public agencies looking at ESG and trying to provide tidy numbers on it, generally don't have the sort of qualitative analysis to back up their quantitative numbers, and so that they can be a bit misleading. You know, I'll just use a quick example with Fidelity China, for example. One of our investors said, you know, you don't show up very well on the ESG numbers. When we said to them, so how many of the stocks are actually rated by your agency? It was sub 20%. So, I mean, it was just completely meaningless, the whole exercise. So I think we need to start to make ESG meaningful, and boards need to work on a way to do that. And finally, delivering performance is what boards need to be all about.
Thank you, Elisabeth. And Andrew.
Yes, thank you all. Yeah, I think from my perspective, you know, 2020 board agendas are going to be very full, or at least they should be very, very full. There's an awful lot to do, but you will know that better than me. So for me, it's all about having the right people, the right skill set, the right focus. And good luck. You know, thank you to you all. I know sometimes I get a feedback that I sometimes give NEDs a hard time, but somebody did once tell me that, you know, you're hardest on the people that you care about the most. So hopefully you'll take it as a compliment, if you can, that we really rely on you guys and ladies, of course. So thank you.
I think Christmas must be getting to Andrew. That was a positively charming end, Andrew. Thank you. Well, it's over to me, I guess, just to thank our speakers for a most interesting and informative session. Thank you very much for speaking today. And of course, a thank you to our audience as well for attending. We hope you found it useful. And we'd be very interested in your feedback. So please do let us know what areas you'd like us to concentrate on for the next one. And finally, on behalf of all of us, our very best wishes for the festive season, and fingers crossed for a successful and more attractive 2021. Thank you very much. Enjoy the rest of your day. Bye for now.
Thanks.